Chapter 3, Audit Planning, Types of Audit Tests, and Materiality. These are the phases of an audit that relate to audit planning. Basically, that just means that these are the three components of the phases of the audit that we looked at last chapter that involve planning. So in the prospective client acceptance phase, we do all of these steps. And again, as you can see, we've got a list here, and again, very easy to test your memorization of that list. Not that I would personally, but, well, that's a lie. I might test your memorization of things. Obviously, open book tests don't do that so well, but definitely for the CPA exam, this would be, again, another list that would be very easy to test on. Then, obviously, this is related to before you have a client. This would be once you have a client and you're continuing to keep that client. That doesn't mean that you're not going to want to look at some of the same things that you looked at in this slide as you evaluate the ongoing relationship that you have. Near the completion of an audit or after any type of significant event, obviously you're going to want to evaluate excuse me, whether it makes sense to continue with that relationship. So as part of the planning process, before or you know, as part of determining that you can accept a client, and then once you've accepted the client, in the planning process of determining how to best audit that client, you're going to look at what your manpower requirements are going to be. Obviously, it's generally going to be a managing partner at a small firm, or you know, at management level at least, as you go up the ladder that's planning these things out. One of the reasons why is manpower would be the single greatest expense in many companies, and definitely with audit firms. So this is a very key, important step. You don't want to under or overdo it in terms of assigning people to the audit. In addition to that, as you're planning out who and what number of people and who specifically to assign to the audit, there are some ethical, there are ethical issues, and then there are some specific independence issues related to whoever might be a part of the audit team and the audit firm in general, as it relates to individuals and the company specifically that it's auditing. Of course, it shouldn't be too difficult to surmise the reason for wanting independence between an auditor and the firm that's being audited. Independence meaning, you know, not already having some relationship that would suggest that the auditor is going to be biased in his or her duties in auditing the firm. One specific reason why it's so important with auditors is because, and we've talked about this before, but the nature of being an auditor and the nature of auditing a company, economically, if you just look at the economic interests involved, you already are in just by the act of agreeing to audit someone, you've already put yourself in a position where you're not a disinterested third party anymore, because you do want to keep the firm happy because you want them to rehire you. So it's critical that you not have, in addition to that economic interest, any other reason or ties to the firm that you're auditing, so that it's more likely that you can be somewhat unbiased in carrying out your responsibilities. There will be an engagement letter between the audit firm and the entity, and this is pretty much a good idea for business practice in general. Before you get into bed with someone in a business or in a business transaction, to set out in writing expectations, who handles what's expected of who pays who what, when, all of the things that are important with respect to two entities getting involved in a business relationship with each other. That will be set out in the engagement letter. During that time, or somewhere around the time of the engagement letter, you want to look at, in addition to things that are outlined here, talking about whether this is going to be an option, whether as an auditor you will have access to the work of the internal auditors, and also what the role specifically within the company you're auditing of their audit committee is going to be in terms of their relationship with you as an audit firm. We already talked pretty much about what the engagement letter should contain. When looking at, assuming that the internal audit papers are available to you, obviously you're not going to be able to just look at that and be like, whoa, the internal auditor said it's okay, so I guess it's okay. Again, because of the nature of independence, or lack thereof in this case. So when you are looking at components or work done by the internal audit team, whatever that may be, from nothing to a comprehensive part of the organization, whatever part of that spectrum you land in, where was I going with that? What all have they done? Have they documented specifically? I guess that would be under systematic and discipline throughout. Anything that was out of the ordinary, has that been documented? Is there any evidence that the papers have been tampered with since they were used? Does it look like they know what they're talking about? In dealing with them, does it seem like they know what they're talking about? All of these, in addition to just what's out there, what's available, are components that you would want to look at when evaluating how effective of information you might derive from the internal audit committee's work. I'm sorry, from the internal auditor's work. The requirement of having an audit committee, something that came out of the Sarbanes-Oxley Act, and basically it was, excuse me, it was an attempt, and still it fails miserably at this, so take it for what it's worth, but it was an attempt to legislate a way to have the liaison of the audit committee, or I'm sorry, of the external auditor. So in other words, the go-between of the company and the external auditor, instead of having that be the CEO, basically, or his or her assignee, instead of having it be a direct relationship with just management, this was supposed to be a way to provide more independence and separate the interests of the audit committee that, in theory, more closely align to the interests of the stockholders. So This is an attempt to make the audit more independent, more reliable, less susceptible to being doctored, essentially. Planning the audit is a requirement as per GAS, or the Generally Accepted Auditing Standards. And as part of that, well, I guess I probably should have mentioned this by now, but the entire time you're doing an audit, from the outset, engagement letter, determination that you're going to take the client, all the way through to delivery of the audit opinion and collection of the fees, everything involved with a particular client's audit goes into a file that's called the audit papers for this particular client. So when we talk about planning, we're not just talking about a vague concept of planning, but actually something that is documented and becomes part of the audit papers and the paperwork that is associated with the client. It's important because what is included in your audit papers and the amount of planning included in your audit papers becomes the official work that was done. So if ever there is a dispute to arise as to what amount of planning was done, the audit papers would be what would be a key document or source to consult. Courts will look at sometimes to determine whether you did your fair share. Okay, so this is basically looking at some of the components of planning the audit, some considerations you should think about. Let's see. We'll look at some of these, most of these, in greater detail here. Obviously, you want to understand the business's risks in its operating day-to-day operations, because if you know where, well, first let me say what we're talking about with risks. We're essentially saying where are the places that this business is at risk of having botched their accounting. Okay, so from an auditing perspective, this would be what I would view as a business risk. So for each particular business, there are specific to the nature of their business, what they do, how they do it. There are areas where they are most likely to be at risk. And of course, for instance, if you know that deposits get taken to the bank twice a day, and so accounts, journal entries are done related to cash twice a day, in these particular accounts, cash being what it is, that's something we're obviously going to look at very closely all the time. So that would be, all of the journal entries associated with those deposits would be items that we would ratchet up there as far as the risk we associated with them. Establishing materiality basically says, look, in our audit opinion, we're going to give our opinion as to whether your financial statements are free of material misstatements. So how can we possibly determine whether they're free of material misstatement unless we know for your entity what materiality is? So this basically involves looking at the entity and determining, okay, given that your bottom line net income or your overall assets, all these things are going to be looked at, but given all of these factors, how much deviation or error, essentially, in your financial statements would be considered material? Or in other words, what amount would need to change in any particular component of your financial statements to cause a reasonable investor or a reasonable user of your financial statements to alter a decision to invest or to not invest, or to loan you money or to not loan you money. Whatever they're using the financial statements for, if the underlying decision that they're using your financial statements as a guide to consult them on, if they would alter that decision based on whatever error we're talking about, then it's material. That's kind of the book definition, or the general definition, I should say, of materiality. So obviously that's going to depend a lot on what types of dollar amounts we're talking about, in terms of, if the bottom line total gross receipts for a company is $50,000 a year, then $500 could be and would be very material, versus like Google or some other company with billions of dollars of assets. $500 there would not be considered material. So this would be the time when we would look at the underlying materials or the underlying characteristics, I guess, of the company and determine materiality. I should also say that this could be broken down. Obviously, we want to establish overall level of materiality, because that's what our letter is going to be based on, or our opinion letter. But we can break that down and say, okay, so that breaks down to each account having this level of materiality associated with it. And we could go and break that down further and further. This is kind of just a diagram illustrating the fact that any area of a business that we determine as auditors to have a high amount of risk, we are going to allocate the most resources to that area. We're going to have some knowledge of the industry that we're auditing, so that we can determine what types of specialists might be needed in doing the audits. IT specialists are often used and need to be involved, just because IT is involved pretty much in all security aspects of most day-to-day operations of businesses now. There are, depending on the industry, there could be any number of different specialists that you'll need to consult. You might look at actuaries, you might, any number of different specialists. So this would be, during the planning phase, would be when you would determine, at least make an educated guess at what types of specialists you're going to need. Should you encounter illegal acts, you should look at whether they're material and indirect, or whether they're direct and material. I won't say any more about that. I would say, as far as legality of things are concerned, I would say use your common sense, and just know that if you ever are on record of knowing something is illegal, there's probably going to be liability attached to you if that ever came out. So just keep that in mind. We look at related parties when we're trying to determine how independent we are, there are some various related party issues that are brought up when we have related parties in key components of a company. Mainly just because we oftentimes will consider related parties to be much more susceptible to acting in unison or conspiring together. So something that we may determine is unlikely to occur because of separation of duties might be more likely to occur in the case of those duties being occupied by related parties. This additional value-added services used to be a huge, I think we've talked about this already even in this class, but it used to be a huge bottom line addition to most large auditing firms. And this diluted independence even further. So Sarbanes-Oxley kind of nixed that as for most publicly traded companies. But a lot of smaller companies will still hire their auditor to do tax planning and some of these various other value-added services. So, from an auditor's perspective, these are potential money makers. It's just an outline of an overall audit plan. Something like this is probably going to be contained within your audit papers. This is just a kind of informational slide. I don't have much else to say about any of that. Supervision of the audit. Who the supervising member of the team is going to depend a whole lot on how big of an auditing firm you're talking about. But eventually, the supervisor of the audit is going to be who signs the audit, the overall supervisor anyway. These are some different types of audit tests. It's kind of just vague terminology that the CPA exam likes to test, really. You're obviously going to use different types of tests depending on what you're trying to determine. And the CPA writers and the powers that be, I should say, in academia, kind of created these vague categories to group these different tests in. So I guess long story short, just because they're in a particular category doesn't mean that they won't overlap in some cases with some of the things described in another category, I should say. When we're talking about tests of controls, these are some of the ways we can get at testing controls, inspect things, ask people questions through interviews usually, just kind of casually observe what happens. Start with having gathered information from people and they've given you, say maybe they've given you a walkthrough of what happens. You walk that through yourself on a phantom transaction or something and see what happens. So those are some various different types of tests of controls. Substantive procedures involve tests of details and analytical procedures. So tests of details would basically be, walking through and comparing source documentation to items that were entered, testing whether something was, whether you can tell, obviously, this was entered incorrectly. Okay, but another way to spot errors is through analytical procedures, which is basically kind of analyzing, use your brain, look at the overall scenario, look at the items that you were testing over here, but also apply that knowledge to various business scenarios, likely occurrences, any information that you have to just basically see if something doesn't smell right, or if it just doesn't feel right, or just through analyzing in that way, you're able to be directed to a particular area that allows you to do more tests of details to determine where errors might have occurred. We talked about the fact that, in putting everything into these categories that are nice and neat and easy to test the memorization of, ignore the fact that in everyday life a lot of this stuff overlaps. So a lot of times you will do one test to test both, or you will look at some components of something that has been categorized one way that overlaps into something else. So just know that as we're going through these, yes, you should memorize the, in terms of the CPA exam at least, you should memorize the lists given, anything that's set out nice and neat into, okay, these are the 6 steps of XYZ. Pretty much memorize that. But know in practice that it's not, most things are not as black and white as that. It's usually some gray area involved as well. And just as I was talking about black and white, I swear I didn't look at this slide ahead of time, we talk about, in terms of materiality, again, the need to not just look black and white. Now it's going to be more of a professional judgment as to what you believe the correct level of materiality should be, given everything that you know, your background, your education, your training, your knowledge of the industry, etc., and your integrity. All of those things come together and, in theory, guide you to the level of materiality that makes sense. Ethically, I should say, and morally, and financially, and in all ways that we're trying to encourage. So, in the application of materiality, it's basically going to come in these 3 steps. During your planning phase, you've established your overall level of materiality. From that, you need to extrapolate down to individual accounts, or at least classes of accounts, how much in a particular class of accounts, taken all together, or how much in a specific account would cause that account to be materially misstated. Okay? Then, once you have kind of set those aside, well, first of all, I should say you're going to want to do both of these items before you're actually looking at the company's books, because you don't want to get established in your head a direction you want to go one way or the other on a company's books as you're going. Well, I think I said that wrong. You don't want to have a preconceived notion of how a company's books look before you determine materiality. That's a better way of saying it. Again, these are some ways that you can do this both quantitatively and qualitatively. These are not all of the examples of things that you can do to determine materiality. Overall, it's going to be a combination of these components that you look at, mixed with just your professional judgment. Step 2 is just going to be allocating that overall materiality down to the account level, or the class of account level, I should say. And then finally, you're going to basically say, okay, these are the guidelines I set out, and these are my actual findings. And, based on those 2 things, I should have an answer as to whether these financial statements are materially fairly presented or have material misstatements. And in the end, that's what I'm hoping to accomplish as an auditor.